ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro. Joining us today, Mr. Michael Borth. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Wednesday, 7th day of July, 2021. Thanks so much for joining us. Whoever you are, wherever you are, we're just glad to have you right here, right now. If you can't see the screen I have up, go to our homepage, cfrn.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and that will give you one-click access to the show each and every day. It also gives you access to the chat box so that you can ask questions and participate in the discussion. On the days you're out of your office, away from your desktop, point any internet-connected browser to cfrn.net/live. There you'll find a live real-time simulcast of the show as it unfolds. You just won't have access to the chat box. We also stream live during the show on our YouTube channel. It's very easy to remember, youtube.com/CFRN. Now, not only do we stream live, we archive each and every daily show. Currently, there are over 1,700 daily live broadcasts archived there for your viewing and educational pleasure. And while you're on the YouTube channel, be sure to click the subscribe button and the little bell. That helps the show to grow. And anytime we go live with breaking news, or for whatever reason, as a subscriber who's clicked the little bell, you'll be notified, so you never miss a thing. With that said, let's open with the word of prayer. Heavenly Father, we thank you for your blessings, for your mercy, and for your grace. Lord, help us, all of us. We need your help. Today, I think more than ever. When we are weak, make us strong. When we waver, help us to lay our anchor down. May we find strength through knowing that you hold us in the palm of your hand. We no longer need to be held down by the claws of the world. Lord, help us to believe that you are so believable. We see your hand in our everything. May we fall into your arms of grace so we never feel the pangs of condemnation that so easily rip us apart. That's not you. That's the world. And truly, we want nothing that is not you. Because whatever it is, if it's not you, it'll only leave us empty. God, you are the one that leaves us on full. Not once, but all the time. God, give us you. Increase our faith. Make us into fighters who won't back down. May we know strongly you are what we need to run after. because you are the answer to everything. You are the only way. Tie our heart to yours. In Jesus' name, amen. Amen. Well, happy Wednesday. Hope it's a happy Wednesday for you, wherever you are. Here's the numbers from around the world. These are the cash markets, or the indices as they're called. Currently, the Dow is up 67 points. NASDAQ is up 23. S&P 500 is up 12. And the Russell 2000 down 13. In the commodity basket, crude oil down $1.89, trading 71.48 last. Now that's a drop of 2.5% for crude. Gold up $10.40, trading 18.0460 last. Silver down 2 cents, trading 26.15 last. In the Asian markets at the close, Nikkei dropped 276 points on the session. That's a drop of just shy of 1%. The Shanghai rose 23. The Hang Seng fell 112. And in the European markets at the close, FTSE posted a gain of 50 points. The DAX rose 181. That's a gain of a little over 1%. And the CAC rose 20. So that gives us a mixed day in Asia, a green day in the UK, and it's a mixed Radio Wednesday here in the US of A. 3 of the major indices are in the green: the Dow, the NASDAQ, the S&P 500. But the Russell 2000, which is an index of 2,000 small cap companies, our man in the street as we call it, the Russell is the only major index here in the US in the red, down 13.5 points. Pretty quiet, subdued trade around the globe. So with that, we'll go to Michael and get a recap of what happened this morning in the live training room. After that, I'll come back. We'll take a look at the concierge trade alerts, the logic alerts. I did do the concierge trade alerts last night, and so all that and answers to your questions when I return. Michael, if you're ready, you can take it away. And if you're not ready, I'll go ahead and go to the daily chart of the S&P 500. Let's just do that. And I'm sure Michael will be here shortly. Okay. So there it is, S&P 500, E-mini futures. Now, we had an outside day yesterday. Red body, bearish engulfing. What's an outside day? Well, an outside day is when the high of this day was higher than the previous day, and the low of this day was lower than the previous day. And in this case, I think we were actually, let's see, the high Friday was 43.47, and yesterday the high was 43.48. So actually this candle engulfed the 2 previous candles. Yesterday's candle was higher than Friday's high, and the low was lower than Friday's low. So a double bearish engulfing. Now, we talked about yesterday the red body. Where would that close? The further down it closed, the more bearish the connotation. And buyers came in and drove us probably better than halfway back up. So a bearish engulfing like this one of the strongest reversal signals in candlespeak. Okay, Valerie says,
Dwayne, you haven't started the broadcast.
but I have.
No.
Well, I
You're
mean,
just talking to me right now.
Well, I know. I'm just saying it's streaming right now.
Oh, okay.
So,
Well,
I mean,
go to webinar's not doing it.
Yeah, well, my that's just the thing. My go-to webinar, it's up and running.
Okay, well, I'll hit it on my end. And it'll start. That's probably what Val's trying to say. Okay, here we go.
The broadcast is now starting. All attendees are in listen-only mode.
There it is. Okay.
All right. Okay, take it away.
All right. All right. Hang on. Did I change my name? I did. Okay. We'll do that and that. Okay. So we had a bunch of issues this morning.
Apparently, we just had another one.
Yeah, we just had another one. I had the same one yesterday. I had to restart. Go to webinar yesterday morning too.
I always click, start broadcast, and then the little voice in my headset says the broadcast is now starting. All your people, are on mute, and then I turn on the streaming software after that. And so, anyway, stuff happens.
Here we are.
So, take it away.
Here we are. All right. All right. Good afternoon, everyone. Today's Wednesday, the 7th day of July, 2021. Now we had some problems in the room this morning too with my charts, and I'll get into that in just a minute. But if you have not taken a free trial with us, go to the homepage here at cfrn.net. And on the homepage, if you scroll down right here to where it says free 5-day trial, no credit card required, click on that. It's going to bring you to this page, eminitrainingschool.com. On this page, if you scroll down, if you scroll down down here, all that we ask for is your name, your email, and your phone number. And you can tell this was the problem this morning by scrolling. Your name, your email, and your phone number. You can tell us the biggest training channel, so we can tell it one-on-one training just for you. Hit the send button. You'll be sent a confirmation link. You must click on the confirmation link. Okay. If you don't click the confirmation link, we don't know that you took a free trial. So you got to click on the confirmation link. All right. All right. Now let's get into the spreadsheet. Now my spreadsheet wasn't working exactly right this morning either. I mean, the spreadsheet itself was, but the scrolling wasn't. But if you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Now, let's see if we can move this over. Yeah, you see, it's only letting me move it over a little bit. Maybe if I can spread it out, we'll be able to see more of it. What if I do this? Well, anyway, I'll just go through what it says. Today, if you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Today is the 7th day of July, 2021. Today in crude oil, we made 49 ticks. In gold, I think I messed something up on the gold, so I got to fix it right now. Let me go here and just check that. Yeah, right there. On gold, we ended up with 43 ticks. So let me fix that right now in the spreadsheet. We had 51, but then I stopped out on a trade. I'll fix it. It's not letting me get in there to fix it. Let me, hang on. There it is, 51. So that was really 43. Okay, we made 24 ticks on the ES. Put us at $1,220 a contract on the morning session. Today it took 5 minutes and 2 trades to get to the goal for the day. At that point, we're up $230 a contract, and we took a total of 27 trades this morning. So on the month now, that puts us at $3,355 a contract. That's over 4 trading days, averaging $838 per contract per 2-hour trading day. Now let me scroll up here and see. Okay. So we've gotten our goal for the day on 127 out of 128 days so far this year. And that puts us at $84,245 a contract. That's over 128 trading days, averaging $658 per contract per 2-hour trading day. Okay, minimize that. And we'll get into what we did and didn't do. Now, let's start out with the DT Pro charts on gold. Okay, you can see they stopped working right here. And this is a live environment, and it looks like it was an isolated problem. It was just me, and it didn't even save all the stuff that I had on gold. But anyway, with gold, we started out, our first trade was for 20 ticks. I believe it was right, I don't know where it was. I think it was right in here. Our first trade, we got 20 ticks profit on it, right in there. Okay, the next trade was right in here. We got 2 ticks profit on. The trade after that, we got 1 tick profit on. I believe it was right here. The trade after that, we got 1 more tick profit on. I believe it was right there. That put us at plus 24. Okay, and then we had to switch to NinjaTrader. Okay, now please be patient with me with these NinjaTrader charts. All right, our next trade was right here, and we picked up 20 ticks on that to put us at plus 44. Okay, then here we picked up 7 more ticks to put us at plus 51. Yeah, to plus 51. We had a break even, another break even. Then we stopped out right there. Right there, we stopped out. Actually, we picked up a couple of ticks here that I didn't count. But here we stopped out for -8, and then we had a break even, and that was where we ended trading on the morning session. Now you can see I had to switch to NinjaTrader charts because my DT Pro chart stopped working at 10:09. Just my DT Pro Gold chart. The DOM was still working, the chart wasn't. So it's something with the chart upgrade that went wrong. So anyway, there was a long right here during the break, and that was pretty much it. Maybe one more long right here, momentum long right there. That was pretty much it during the break. There wasn't much to go on with gold. Now I'll do the ES because we had some pretty good trades here on the ES today. And the ES was acting pretty well. Going most of it, put in all new highs again today. Early on this morning, it was right here. Okay, and let me get rid of this drawing object right here so it doesn't crunch up so much. Our first trade on ES was right here. We ended up with a break even. Okay, then we missed this. Here we picked up on the ES, we picked up 1 tick to put us at plus 1. Then we picked up 12 ticks right here to put us at plus 13. And another 8 ticks right here to put us at plus 21. And then we got back into the zone and there was no trading going on in there. And right over here, we picked up another 3 ticks toward the end to put us at plus 24. And then we get into the break. We had to break this dynamic resistance in here. And looks like right in here, there was 1 more long during the break. And that was pretty much it. Okay, so on gold, we picked up 24 ticks this morning. All right, and crude now. Crude, we had a bunch of trades. I'm going to scroll back here to the beginning of the crude. And I'll get into that. Here it is. All right. So on crude, our first trade right here on crude was plus 3. And then we had gone and picked up that 20 ticks on gold. That's put us at plus 23. That was where we got the goal for the day. Put us at plus 230 on the morning session for the goal. All right, but right here we picked up 3. And then we picked up another 10 to put us at plus 13. Another 5 to put us at plus 18. Then it looks like 7 to get us to plus 24. Or 6 to get us to plus 24. 1 more to 25. And you see crude was doing everything that it should. It was going to all the targets that I was putting in for it. Down here, we picked up 1 tick over there to get us to 25, and then 12 ticks here to get us to 37. And then in here, I missed a trade right in here, but this is when all the stuff was starting to happen with the crude oil. I mean, not with the crude oil, with the gold. So I ended up missing a few trades while all that was going on. I mean, I was trying to figure out what I was going to do there. We ended up with a break even there, and we went from 37 to 43. So the next trade should be a 6-tick trade, was right there. And from 43, we went to 53. This one right here, I don't think I counted. We had a couple of trades here that I missed. Trade there that was the break even. Okay, we went from 43 to 53 somewhere, so we had a 10-tick trade in here somewhere. That might have been the 10-tick trade. I don't know, but there was a 10-tick trade to get us to 53, then a 1-tick trade to get us to 54, and then we stopped out. So this might have been the 1-tick trade, and I missed those. The 10-tick trade might have been right in here. That would have made sense. The 1-tick trade and the 10-tick trade being an opposite. Like that might have been the 1-tick, and this might have been the 10-tick right over here. I'd have to go and look. But anyway, we missed that one, we missed that one. We got a break even there. Missed that one, and that one. All those ones that we missed would have been profitable trades. Then we stopped out, and that brought us back down to 46. And then we picked up we had a break even. Then it looks like we picked up 3 ticks there to get us to 49. And we had something there that I didn't record. And then getting toward the end of the session, the cycle was kind of messed up down here. So we really weren't getting a lot of trades. There was one right here. It turned around and started to go up. There was one long right there. That was at the break, so I didn't really do anything in there. Short right there off the BBC. Now this one was the highest probability trade. You see, MA1 stayed red, bounce off the BBC, and the cycle is red. Nice separation. Highest probability trade right there. And that looks like pretty much it. We might have had a long right here, momentum long. This didn't go anywhere. You could have grabbed another long from right here, pick something up right there. If I had drawn a trend line, there would have been a long right here that would have given you a little pressure, but it would have moved up eventually. And that was it for the crude oil. Okay. All right, so back here now. Back to my spreadsheet that doesn't work. Well, it works. Everything's calculated right. I just can't get it to scroll properly. All right, so if you're going to read the spreadsheet, you got to read all the CFTC risk disclosures down at the bottom. Today is the 7th day of July, 2021. Today we made 49 ticks in crude, 43 ticks in gold, and 24 ticks on the ES. Put us at 12:20 on the morning session. Yeah, put us at 12:20 on the morning session. Sorry. 12:20 on the morning session today. It took 5 minutes and 2 trades to get to the goal for the day. At that point, we were up $230 a contract, and we took a total of 27 trades this morning. Actually, we took a total of 28 trades. Let me fix that. That last gold stop out. So on the month now, we're at $3,355 a contract. That's over 4 trading days, averaging $838 per contract per 2-hour trading day. We've gotten our goal on 127 out of 128 possible days this year, and that puts us at $84,245 a contract. So over 128 days, averaging $658 per contract per 2-hour trading day. Let's go back here. Emini Training School. If you have not taken a free trial with us and you want to, simply go to eminitrainingschool.com. Here, all we ask for is your name, your email, and your phone number. You can tell us the biggest trading channel so we can tailor one-on-one training just for you. Hit the send button. You'll be sent a confirmation link. You must click on that confirmation link, okay? If you don't click that link, we don't know that you took the free trial. So make sure you click on that link, all right? All right, that's it, guys. With that, I can wrap it back up and pass it back out to fabulous Phoenix, Arizona, Studio A, overlooking South Mountain, America's largest city park. Dwayne, if you are ready.
Yes, sir. I'm ready.
Excellent.
Okay, recap of the recap.
Today it took 5 minutes and 2 trades to get to $230 a contract.
Good job.
Thank you.
Good job. I posted a chart last night in the passport holders discussion.
Oh, here it is. Yep.
Yeah, so it's just that's what it looked like off the open last night. It's just that same chart that we've been talking about since the partners workshop last Thursday night. So for any of the members who missed last night's workshop, if you would like, you can always find it in the private workshop Telegram channel. We have a channel for just about everything, and so
Yeah, we do.
that
We do
will
indeed.
put that chart in context for those of you that did not see the work, not there for the workshop. So you can be up to speed with everybody else. So, okie doke. So, good morning in the room. Michael got to go.
Yes.
So far this week on Logic 247, we are now in week 153. 153. Now, the Logic Alert channel opens for business Sunday night at 6 p.m. Eastern, remains open until Friday afternoon at 5 p.m. Eastern. There's a 1-hour break each day, Monday through Thursday. Today's Wednesday, we all know that. The Wednesday session will officially close this afternoon at 5 p.m. Eastern. And then tonight at 6 p.m. Eastern, the markets will reopen. And that is the beginning of the Thursday session, even though it's still Wednesday night for those of us here in the U.S. Okay. Once Globex opens, then we have the Asia Open, then we have the London Open at 3 a.m. Eastern. And of course, we all know Wall Street opens at 9:30 a.m. Eastern. Now, the Logic Alerts are based on current price action. Now, by current price action, what I mean is it's what's happening right now in the markets, but I build a buffer into the alerts. The goal being that you have, once you hear the alarm sound on your cell phone, your tablet, your PC, or your Mac, once you hear that telegram sound, you have time to finish what you're doing, to get to your computer, to get your charts up, study the alert, study the chart. The purpose is, number one, we want you to be able to trade the alert. Of course, you're going to trade in SIM in the beginning until you put together 10 consecutive days in a row where you reach your goal, and that qualifies you to go live. The 2420 blueprint walks you through that entire process. That question came up, I think, yesterday when I was talking with someone. How much time from when the alert's published do I have before I have to pull the trigger? Okay. In the live training room, okay, it's a different scenario, because Michael is, as he's teaching you the methodology, as he's teaching you the strategy, and you're asking questions, he's putting on and taking off trades right then in the moment. But the Logic Alerts, again, there's a buffer time built in. Now, I shoot for, roughly 20 minutes, but nobody knows what's going to happen next. And so that 20 minutes could become an hour, could become 2 hours. Occasionally the market will have a sudden burst of energy, and the alert might trigger, before 20 minutes. That's not intentional. The intent is that you have at least 20 minutes, because the purpose of the alerts is not just so that you can trade them and make money, but the purpose of the alerts is so that you learn how to spot these windows of opportunity yourself. In other words, your phone makes the sound, you go to that chart, you read the alert, you study it, and then you see the reason for that trade. You understand the entry, you understand the targets, all of that. Okay? Now that's based on current price action. The concierge trade alerts, the original alerts, the CTAs as they're called, or daily trading zones as I've started to refer to them of late, those are based on historic price action. Now, those don't come out around the clock. There's a static report published for our members shortly after the Globex Open each evening. Those numbers become your forward guidance for the entire session. Once an alert triggers, whether it's a Logic or a CTA, there is a greater probability of it triggering again and again. Sometimes we see 3, 4, 5, 6, 7 triggers off of one alert. Why? Because important prices and important areas are almost always tested. It doesn't matter what strategy or methodology you use, that's just a truth about trading. Important prices, important areas, almost always tested. Now, this week so far, week 153, as of 12 noon today, of course we had the holiday Monday, we've issued a total of 25 logic alerts, 8 never triggered, still waiting on the results of 4. So we've had 13 actionable alerts so far, of which 23% would have stopped out based on not risking more than $300 per contract, per trade, less when possible, using market structure and a very simple 3-step process that we teach all of our traders. Now, the average over the last 153 weeks is 20% of the logic alerts do get stopped out. We don't know what's going to happen next. Neither does anyone else, because that's not how God created this universe in which we live. He never gave Adam the ability to know the future or change the past. And those two things are inextricably linked for eternity. Now, I know a lot of clever websites and, well-written ad copy and emails would lead you to believe that, every organization out there has a crystal ball that tells them with certainty what's going to happen next, but not to rain on anybody's parade, that's just not possible. It defies the laws of science, physics, even the laws of God. Now, since we can't know with certainty what is going to happen next, what we can know with certainty, based upon market structure and how price flows, we can know with certainty what the next high probability move will be. And based on over 7,000 individual alerts, 7,700 and change I think it is, over 153 weeks, we know that 20% of the time, on average, the market does not do the next high probability thing. Why? Because order flow switches. In other words, we get into long trades, of course, because there's more buying pressure than selling pressure. We get into short trades because there's more selling pressure than buying pressure. But at any given moment in time, it can switch. There may be not because of a news event, not because of anything in particular. It just happens. And so we understand that going in. Every time you place a trade based off an alert, you know with certainty that on average 20% of the alerts you trade will be stopped out. Again, the risk profile is different with the alerts than with the live room. In the room, Michael uses a fast time frame, a range chart, for a number of reasons, okay? But primarily, he wants to be able to show you the trade setup as many times as possible during that 2-hour session. If we were using a 30-minute session in the room in the morning, you might only see 1 or 2 alerts. Some days you might not even see any, okay? The risk profile is different. He uses an 8-tick hard stop on every trade, on every market. What he's teaching you there is the importance of always having a hard physical stop. If you choose, once you learn the mechanical model, once you learn the methodology and the strategy, if you choose to trade larger time frames, then you certainly can. And so that's where we teach you about market structure, because each trade is a unique moment in the market, like a snowflake. Everyone's unique. And so we allow the chart to tell us where the stop loss needs to be. Now, if the chart tells us if we're going to enter at X, The chart will tell you where the stop loss needs to be based on market structure. If that's more than $300 per contract, you go to step 2. If that's still more than $300 per contract, you go to step 3. And if step 3 is still more than $300 per contract, you simply pass on trading that particular trigger, and you wait for the next trigger on that alert, because once an alert triggers, there's a greater probability of it triggering multiple times than not. Or you simply look at a different alert, you look at a different market, and as you learn the methodology and the strategy, you don't need Michael to call out a trade in the room. You don't need me to send you an alert, because our goal is to teach you how to become self-sufficient in the markets. You do not want to spend the rest of your life depending upon someone or something, whatever that might be, to tell you when to get in and when to get out. You want to take control because it's your trading business. You should reach a point pretty quickly where, if you're asking lots of questions in the discussion group and in the live room and on Thursday nights during workshops and in mentoring sessions, then pretty soon, because we don't switch it up every day. It's not, well, today's this kind of day, so we're going to behave like this. Or, well, today's different than yesterday because of whatever reason, so we're going to change our swing today and do things differently. This is so important to remember. Everything that we do is fluid across all markets and all time frames. Price flows on a monthly chart the same way it flows on a 1-minute chart, a 30-minute chart, and a range chart. It has since the inception of the markets, and it always will. Price moves from support to resistance, back to support, back to resistance, over and over, again and again. It is a never-ending cycle. Now, our indicators work as dynamic support and resistance. Our weekly trading zones, those act as fixed support and resistance. Some people will tell you, well, you can't trade support and resistance anymore because that's old-fashioned, that's horse and buggy. You know, there's algorithms now and all kinds of shiny objects and indicators and oscillators and all that jazz. Okay? Well, believe what you will, but go look at any chart in any time frame, and you'll see that what I said is a truth about trading. Price goes from support to resistance, back again, over and over, from the moment the market's open to the market's close. Also, price itself is trying to get to a weekly trading zone every moment the market is open. When price is above the BBC on a 30-minute, we know price is trying to get to the zone overhead. When price is below the BBC on the 30-minute, we know price is trying to get to the zone below. Only 3 things happen at a weekly trading zone. The thing you'll see most of the time is consolidation. Second most likely is rejection. The third and least likely is the slice. As we go through the charts, I'll show you some examples of those. So one more time, so far this week, with the holiday and all that, 25 total alerts issued prior to them triggering. Again, the purpose of the alerts is so that you learn to spot opportunity in the market on your own without help from anybody. And then you use everything that Michael and Val teach you in the live training room to participate in the window of opportunity. Trading's not easy, but it can be simple. With that, we'll go to last night's CTAs. So if you want to grab a screenshot of those, you can. Here they are. Okay. So last night, Markets opened at 6 p.m. Eastern. I got the CTAs out at 6:20. There's two numbers for each market. As you'll see when we go to the 30-minute charts, best way to handle these are just go put a line in the sand. Put one at 43.40 on the S&P and one at 43.21. Once this static report is published, if price starts trending towards 43.40, that's bullish, and so our strategy will look for opportunities to buy the market, buy the dips. Price starts trending down to 43.21, that's bearish, so our strategy will start looking for opportunities to sell the market or sell the rallies. And then you just do the same thing with each one of the markets. Now, what I recommend to all of our traders is that you start your trading session with the daily chart. Now, if you're just a crude trader, well, that's what I do. I just trade crude. Okay, well, then go look at your daily chart of crude. The S&P is considered, I've heard it called, the bellwether. It is 500 large cap companies. The Dow's 30 blue chip. NASDAQ's the top 100, the NQ. The Russell is 2,000 small cap companies. So, you know, whatever, or we do gold, we do silver, and crude. So whatever your trading vehicle is, if you just have one, okay? Now, because our strategy is fluid across all markets and all time frames, hopefully over time you won't limit yourself to just one market. I mean, if you want to, that's okay. If you just want to trade the S&P and nothing else, there's nothing wrong with that. But as time passes, you'll start to see that even though these different markets have different personalities, they still flow the same, from support to resistance and back again. And so you're sitting there watching the S&P, waiting for the trade setup, waiting for a high probability, low risk opportunity, and you happen to glance over and you see that while you've been waiting for the S&P to give you a setup, crude or gold or whatever has already given you 3 opportunities. So at some point, as you're confident in your ability to trade the methodology, trade the strategy, chances are you'll start to take advantage of the opportunities presented in the other markets. If you're just trading one market, again, there's nothing wrong with that, okay? If you want to focus on that, you know, learn the method, learn the strategy, have all your questions answered. Keep an eye on the other markets, and you'll start to see that the pullback holds more often than it doesn't. When price reaches a weekly trading zone, it tends to behave in a particular way. So it's a process, okay? No overnight riches. You're building a business. You're learning a trade. It's just like if you wanted to become a mechanic or a plumber or an airline pilot or a brain surgeon. Obviously, somebody is going to have to teach you how to do that, whatever it is. With trading, because there's such a low barrier to entry, people often fall into the trap of thinking they don't need anybody to teach them, because with a historical chart, it just looks so simple. And remember this too, as you watch videos around the net and blah blah, anybody can look like a genius with a historic chart. In the live training room, you're seeing live in real time. This isn't historic. So it's not so simple to look like a genius when you're dealing with live markets. Same goes with the alerts. Okay, the alerts come out well ahead of the trigger so that you have time to understand why that's a window of opportunity, what the parameters are, and then that's where you have an opportunity to use all the techniques, everything that Michael and Val teach you in the live training room. In the beginning, you should not start trading live. Once you become a passport holder, you'll receive the 2420 blueprint. that's designed to help you go from 1 to 20 contracts over a period of 24 months. We want you to start trading right away. You'll have no clue what you're really doing, but you're listening to Michael and you're just doing your best to follow along, and that's exactly what you should be doing. But do not trade your live account until you qualify to go live. And the blueprint defines that as this. You need to put together 10 consecutive days in a row where you reach your goal in 10 trades or less before you go live. In fact, once you've put together those 10 consecutive days in a row, the blueprint gives you the green light to go live with one contract. Now that you're trading real money, a whole new set of dynamics come into play, all kinds of emotions and etc. Fear of loss, fear of missing out, all these things. Which is why you start with only one contract. Your goal, once you go live, is to increase your account balance by $2,000. Once you've increased your account balance by $2,000, the blueprint gives you the green light to add a second contract. The second contract is being added with profit you earned in the market. The blueprint will always notify you when it's time to add, but you only add one at a time, and you only add with profit you earned in the market. So once you qualify to trade 2 contracts, you're going to spend a period of time based on the calendar trading at the 2 contract level. And then when it's time to add number 3, you'll add the third one, and you'll spend a period of time trading 3 till you get the green light to add the 4th, etc., etc. If you happen to be an S&P trader, 2 points in the S&P, trading 1 contract, it's $100. When you get the green light to add your second contract, the same 2 points become $200. And at 5 contracts, the same 2 points become $500. And the same 2 points, once you reach the 10 contract level, that becomes $1,000 a day. That actually puts you in the top 3% of wage earners worldwide. The worst thing you could possibly do is see how simple it all looks and just dive in and start trading 10 contracts. And the justification being is, well, I got the money. That's awesome. Hang on to your money. New traders tend to focus on how much can I make, when really your focus should be how much can I not lose as I'm learning how to do this. Most traders who've been at this any length of time, there's a cycle. You trade in sim, you go live, and then when you go live, everything falls apart. Pretty soon you've blown up the account, and you're re-upping, you're refueling that account, and you just keep repeating that process. As long as you go down the same road, you're going to end up in the same place. As long as you use the same recipe, you're going to bake the same cake. Something has to change. 9 out of 10 new traders fail. That is an alarming statistic, but it's true. Futures Magazine wrote an article in 2006 explaining that 9 out of 10 new traders fail. They didn't really explain why, but I, being a curious sort, decided to figure out why, because the toughest jobs in the world, maybe like a Navy SEAL, okay? That's a tough job. I was in the Navy, so I know a little bit about it. I certainly was never a SEAL, nor did I attempt to become one. But even that most difficult job, and it's difficult physically, psychologically, I mean, it's hard. 9 out of 10 don't even wash out of that. So I was really perplexed. Why? Well, come to find out, there was a common thread 9 out of 10 people never had anybody teach them how to do it. Now, watching a series of videos or reading some books, watching other people trade, okay, that's not the same as having someone teach you. I mean, we can all learn how to put an engine together by watching a YouTube video. We may not get it right the first time, and we may get frustrated and give up, but the only way you'll ever actually learn how to take an engine apart and put it back together is by doing it. The same with swimming, okay? You can watch videos of Mark Spitz swim for a year, and you're no closer to learning how to swim than you were when you started watching those videos. You may understand some terminology, you may know what a breaststroke is now, but you don't even know what the water feels like if you've never been in a pool. That's why we want you trading right away as soon as you become a passport holder, but in your sim account, okay? You need to prove, not to us, but to yourself, that you understand the strategy. And once you've put together 10 consecutive days in a row, that's a pretty good indication that you've got a pretty good handle on things. So, let's just go to the charts. I think I gave you a chance to grab a copy of the CTAs if you want them. 5, 4, 3, 2, 1. These numbers are good for the entire session. Okay. Alright, so we'll go back to that daily chart we were on. And here's where we stand. New all-time historic high. Intraday and closing high. And then an inside day. And then yesterday we had a bearish engulfing candle. I already explained what that means. You know, had we closed with a red body that extended below the low of Friday, then there would be more bearish pressure on the market. The fact that we recovered by better than half, that actually gave the market a bit of a bullish connotation. I mean, this thing can still go either way, and that's true of any day. If we take out the low of today, you see this trend line that's been with us forever started out as an ascending price channel, which got violated a bunch of times, and we've tested it from the bottom. I won't go through the whole explanation of that again because I do it all the time, but suffice it to say, we closed this day right at that lower trend line. We popped up to put in the new intraday and closing high, and then price retraced right back to that lower trend line. Not only did we hit the lower trend line, we hit the step line, and we hit blue and climbing. Any one of those three things individually is a reason for potentially good support. So we had 3 reasons why the market could find support in this area, and it actually did. Now price has run into resistance. Okay, the high on this day was 43.47. The intraday high here was 43.48, and the intraday high here 43.50. So we took out the high of yesterday by 2 points. We're just off the high of the day. We've got a big strong green candle here. The next obstacle that we have overhead would be the 100% Fibonacci price extension. Looking left won't do you any good because there's nothing there. We're in uncharted territory as we move up into this area. Now we do need to adjust this by a couple points. So on the entire move up, which began November 2nd, I just adjusted that one. And now the last leg up, I've adjusted that one. Fibs are an area, so, you know, try to get them to line up best you can. just know that it's an area, so if it's not exactly Johnny on the spot, it's okay. It gives you an idea. So we now have a new all-time historic intraday high at 2 points. And if the market were to close right here, right now, we would have a new all-time historic closing high. And the closing price carries more weight than an intraday high or low. So we know resistance is overhead at the high all-time 43.50, and then 43.62. If price trades below the low of today, then our next area for support, I mean, we would have to come down through blue and climbing, through the step line, through the trend line, and then that would give us a little window of opportunity down to the low of yesterday. If we trade below the low of yesterday, then this window of opportunity that I drew yesterday, that comes into play. And because we moved a little bit higher, this has to be adjusted. Now the entire move up, which began November 2nd, the 24% fib retracement, that's the shallowest fib retracement, is down at 40.85. This last leg up, the 24% fib, is at 42.73. And you'll notice that that fib of the last leg up, the shallowest possible fib retracement, lines up with the daily BBC. So if price drops and overcomes all the obstacles I mentioned, enters the window of opportunity, we got three things going on here. We've got the 24% fib retracement, we've got the daily BBC, and we have the 62% Fibonacci price extension. On the way up, that's potential resistance, but on the way down, it becomes potential support. So if price finds itself down in this 42.70 to 42.75 area, we would anticipate a nice bounce. Okay, will it be enough to take out this high? Only time will tell. We look at the daily chart first just to get an idea, a high-level look at where major support and major resistance is, because you can't always see that on a smaller time frame. So this sort of puts things in context. We know where we're going to run into major resistance, and we know where our various areas of support are. So depending upon your monitor configuration, you might always have, a daily chart running on one corner of your desk on a monitor, and you've got, whatever chart you're actually placing trades on in front of you. You don't have to stare at a daily chart all day, because you can do what I just did, and you could just make a note. Major resistance, 43.50. Major support, 43.20. Okay. Armed with that information, you're now ready to go to the smaller time frame. In fact, I'll make that note myself, 43.50. 43.20. Now, those will both be visible as we go to the 30-minute chart. And here we go to the S&P. Okay. So the market opened last night right here. That's the vertical line separates the Tuesday session from the Wednesday session. These are current weekly trading zones, and this is last night's CTA. As I said, you can almost think of a CTA as like a daily trading zone. We've published the weekly zones since December 14th of 2009. The most likely thing to happen when price hits a weekly trading zone is this: consolidation. Now there's two lines here, 31/32, but every zone, like this one's 52/53, this one's 17/18, but I went to the one-line format just to try to keep the chart as clean as possible. So price in this case came down. Well, first we had all the consolidation. Then we ran up to the CTA. And the first trigger took us up to 42.75. So that's 2 3/4 points. That says 43.40 1/4, but it's actually just 43.40. Okay, so first move up, market made 2 3/4 points available. Now I said important prices, important areas are almost always tested. Price pulls back and finds support at blue and climbing. It gives us another high at 43.43, so that's 3 points the market made available. Then we dip back below the trigger, and then the market gave us a 5.5 point opportunity. Price got back below the trigger, and this time it's different. Okay, now this time we did get a high up at 47.5, so that's 7.5 points that the market made available. But what's different is on these moves you had the support of blue and climbing. Okay, the green line BBC just stands for bull bear cross. Above it we're bullish, looking for higher prices, opportunities to buy the market, buy the dips. Below it we're bearish, anticipating lower prices and looking for opportunities to sell the market. On this trigger, although it worked out quite well, you should be aware that red and falling on this particular time frame will quite often act as good resistance. And if you'll notice the body of the candle closed right at red and falling. Did we spike it? Yes. This is the 9:30 a.m. opening candle on Wall Street, okay, which typically is the largest candle of the day, the largest 30-minute candle. That wasn't the case today, but there was some, pretty good volatility. We reached all the way up to 47.5, but then we closed right at red and falling. So even though we spiked it, we have to say it held, because it did. Then the following candle took us below the BBC. See, all of this is happening above this is all bullish because we're above the BBC. The other indicators called the CFMA1, red and falling, blue and climbing. That's how I refer to it. Okay, one bearish, one bullish, one resistance, one support. Okay, so price drops through the BBC. It hits the weekly zone at 43.31/32, and it holds. Well, what about that wick? Yep, price did trade all the way down to the CTA, which is 43.21. Right there. Looks like it spiked it by one tick. 3 ticks. The swing low was 43.20 1/4. Basically, price was rejected. Now, I said earlier that only 3 things happen at a weekly trading zone, the most likely being consolidation, 70-75% of the time. The second most likely is rejection. This is what rejection looks like. That's not a weekly zone, that's a daily zone, or CTA. But as you can see, price, this was a huge red candle. Okay? But before the 30-minute period was over, buyers came in and drove us back up to close where? Right inside of that weekly zone. Now, the zones come out to our members Monday morning at 6:15 a.m. Eastern. When we have a Monday holiday, they come out on Tuesday morning. But they're based off of my calculations on Sunday night, as they are every week. price has been behaving at the weekly trading zones since the first time we publicly published them, December 14th of 2009. Consolidation most likely, rejection second most likely, the third and least likely, but it happens, the slice. That's when price slices through a zone like it's not even there. Now, this is not typical slice behavior, and the slice only happens 5-10% of the time. What typically happens is when we slice a zone, when the move runs out of steam, it will reverse and go back to the zone it sliced through and then continue in the direction of the slice. So it actually did that, but it's usually not drawn out over this much time. I mean, this is quite a few hours. But after we sliced through the zone, now this red dotted line, that's today's CTA, not yesterday's. I just don't have a way of stopping this dotted line from not going that way. So, but anyway, I won't bug you or bother you with all that. So when price drops to a weekly zone, what do we expect? Well, we expect it to be good support until proven otherwise. When price goes up to a zone, we expect it to be resistance until proven otherwise. Okay? And this is what otherwise looks like. Because we're trading in the zone. Okay? Price is sort of trapped between the BBC and the CFMA1. And we get a candle that closes. We've got blue and climbing again. Starting to see that separation. Okay? And so the close of this candle right here creates an opportunity to be long at any point on the way up. I mean, this candle opened at 43.34 and it ran up 6 points. Okay. The only obstacle in our path looking left was this swing high at 37.5. So if you wanted to wait for this high to be taken out, perhaps you entered at 38, 39, maybe you waited for the actual trigger at 40. You don't have to wait for the published trigger when you can see clearly that price is trending up towards that CTA number, right? I mean, here's the opening candle last night. We took a little dip below the VBC, got above it, just ground sideways for quite a few hours, but we're in an uptrend based on the 30-minute chart, price, and the BBC. When price is above the BBC on the 30-minute chart, we know that price is trying to get to the weekly zone overhead. When price is below a weekly trading zone, below the BBC, we know it's trying to get to the zone below. Okay? So if price is below the BBC, that's bearish. We're looking for lower prices. Price came. Now, did we spike the zone? Was there some volatility here? Absolutely. Did the zone ultimately hold? Well, it did. In fact, you'll notice on the way down, this step line, the black line, it's on the left side of red and falling. Remember, red and falling is bearish. Okay. Now, down here, when price finds support in this area at the weekly trading zone, price stops falling and starts to walk sideways. We get a doji, and we get another spike lower, which is reversed and sent right back up to the zone. Okay, and then we begin the march back to the zone, which we expect to be good resistance until proven otherwise. And it was. We spiked it, But you'll notice each one of these three candles is still connected. It's still touching that weekly zone. So price went from support to resistance. When price pulls back to the BBC, we expect it to be good support until proven otherwise. So from support to resistance, back to support, back to resistance, back to support. You get the idea. Resistance, support, resistance, support. If all you're looking for is a 2-point move in the S&P as an example, okay, what does 2 points look like on this chart as I have it currently scaled? Well, the high of that little rectangle is basically 43.08, and the low is 43.06. Okay, so a little generous, but 43.08, 43.06. That's 2 points. Okay, so the price is moving down. That's what 2 points looks like on this chart. And then there's 2 points. And then there's 2 points. And then as we start to climb, 2 points after 2 points after 2 points after 2 points. When your indicators go flat like this, best to stay out until the market proves that it actually wants to move higher. We need proof that buyers are more committed than sellers in order to go long. And so price shows us. And so this green candle here, you know, it ran from 34 up to 40, 6 points. So this little rectangle would fit in here. It's like about 3 times. Okay, that's 2 points. Now, when you get your 2420 blueprint as a passport holder, there's a couple tasks that you have to complete. You won't do it in an afternoon. It's going to take probably as long as it takes for you to qualify to go live. You got to write your business plan. You're going to write your trading plan. Along with not having a teacher, 9 out of 10 traders don't have a business plan. They don't have a trading plan. And those are 2 very different and unique documents, and you really do need both. So 9 out of 10 traders fail because they don't have a teacher, don't have a business plan, don't even have a trading plan. They're just looking for something that looks like a move, and so you see it, you click it, and isn't it amazing how you nail the spot where the market reverses? I mean, you could almost sell that as a strategy, right? Man, every time I click the button to go long, market turns on a dime, heads south. Okay, well, you've got a good eye because you're spotting the important price, important area in the market. You just haven't yet learned how to put it into context. And just doing the opposite of whatever you think you should do, that doesn't work either, because guess what happens? The same thing. Okay? So you got to bring all the pieces of the puzzle together. And it begins in the room with Michael teaching you the basic underlying strategy, the principles, the methodology, everything. Okay? In the room, that is a mechanical model. There is a rule for everything. There's nothing that can happen on that chart in the morning in the room that we don't have a rule for. Okay? Now, there's not 100 or 1,000, and the rules are not ever changing. There's a handful. Okay? Trading is not easy, but it can be simple if you let it be. I'm sure you've seen people's charts. Yours might look like this too, I don't know. Where there's 9, 10 different things. Half of them are measuring the same thing as the other thing. They're just displaying them in a different format. I mean, you can display any indicator. You can make it a line, you can make it dots, you can make it columns, you can, but it's the same data, it's the same information. It's just being displayed in a different format. So if you're not using our methodology, our strategy, our indicators, evaluate what you're using and try to figure out what actually helps you. What helps you to be profitable in the market? If you've got something on your chart that you can't 100% say, I use that, I know why I use it, I understand it, and it's part of my definable edge, and I have great faith in my definable edge, well then that's a keeper. The other stuff is a distraction. I have enough voices in my head telling me what to do. I don't need a bunch of indicators and oscillators on my chart screaming at each other, go long, go short, go long, go short. That's a recipe for disaster. So if you're not using now if you become a passport holder, you own our indicator set for life. Okay? Plain and simple. And that's all we use. You'll never see us dragging out, new stuff. We've done the same thing every day since 2008, I guess it is. Long time. If it's not broke, no reason to try to fix it. So we can see that the S&P, it did come down to the CTA on the short side. It was rejected. We triggered again. Now, this time, okay, here on this trigger, we've got red and falling looming overhead. And boy, did it send the market lower. Okay? On this next approach, we've actually overcome red and falling before we get to the trigger. So this would be this I would not mess with. This is acceptable, okay? However, I would encourage letting price perhaps, make 43, 42. Make sure you're going to pull away from that CTA. Make sure because we don't change the blue and climbing until this candle, but you really can't even see it to this candle, and the market's already, it almost made it to the zone. The swing high was 43.50. The zone itself is 52.53. So we triggered once, twice, 3 times, three good triggers because we have blue and climbing. And we have a 4th trigger I would stay away from, even though it worked out. The 5th trigger, it's okay, but be cautious because you already overcame red and falling, and if price continues higher that red and falling is going to become blue and climbing. Okay, and so it's another trigger there. Is price trying to come back and give us yet another trigger? We're printing a red candle. That means price is dropping. Price will continue to fall until it reaches a price that sellers are comfortable buyers are comfortable buying at. Okay? Now our indicators help us. Initially, the step line, good support. It's potential. If it gets through the step line, then right at the CTA trigger, we've got the BBC, which is price always reverts to the mean. The BBC determines if we're looking for long trades or short trades. Okay, and so when price drops to the BBC, we expect it to be good support. The pullback holds more often than it doesn't. It held here, it held here, it held here, it held here. Eventually, we know it's not going to hold forever, we would end up with sideways stagnant markets that were untradeable. So we know that there's going to be a leg, a retracement, a leg, a retracement, a leg, and a retracement, and then there's going to be a deeper retracement. So this move gave us here's a low, here's a higher low, and now we have a higher low. We could, if we wanted, we could draw a little trend line across there. Okay. Now, is there a price channel? I highlighted that trend line. I hit Control C on my keyboard. I'm going to click my mouse up here and go Control V. What that does is it gives me a trend line at the exact same angle. Okay, so now we've got to move this into position, but you want to grab it from the middle. If you grab it from the end, if you grab it from either end, it's going to change the angle. And a channel, the lower trend line and the upper trend line have to be at the exact same angle in order to accomplish what you're trying to accomplish, which is to see if there's a channel. Now we would have to drop it there. Is that okay? In my book it is. Okay. Some people would say, well, you gotta go there. Okay. But I want to see where I get the most touches. Okay. In fact, I could even tighten it up like that, because the body closed below the trend line. We spiked it. We touched it. We touched it. We touched it. We touched it. So I'm okay with that. Red candle, prices coming down. We expect this area to be good support until proven otherwise. If it does hold as good support, we'll know because we'll start printing green candles, and that'll give us an opportunity to trade to the high of the session, the all-time high, and the weekly zone overhead at 52.53. If this pullback fails to hold, in other words, this red candle and the next red candle comes down and closes below these indicators, we'll have a window of opportunity on the downside. So whatever the market does, we just don't want to see it do this. Okay? That, you just got to resist the urge. Let the market give you a clear reason, an obvious reason to get involved. Okay? So this window of opportunity here, 43.36. Oh, down to initially, if you're just looking for a 2-point target, it would be 36 to 34. And then you've got the zone at 31.32. So potentially a 4-point window of opportunity here. If support holds, then we can't know with certainty until the market structure develops. Okay, now like in chess, you can think 2, 3, 4, 5 trades, moves ahead. If you're a really good chess player, I'm not. I play checkers. Speaking of chess, if you haven't seen the Queen's Gambit, that was an exceptionally well done miniseries. And again, I don't play chess, but I really enjoyed the movie, the way it was filmed, just everything about it. It was very, very good. All right. So I think we've said everything basically that we can say about the S&P chart. Multiple triggers at the CTA. Price trying to work its way back down to support. It found resistance. Why is 43.50 the all-time historic high? Because at that moment in time, all traders, great and small, actively involved in the business of trading, at that moment in time, nobody was willing to pay $43.50 and a quarter. I'm sure there's expensive, fancy reasons driven by algos and thousands of lines of code. But if one trader somewhere in the world had chosen to click buy at $43.50 and a quarter, that would now be the new all-time historic intraday high in the market. But that didn't happen. What happened is at $43.50, buyers stopped buying. Okay, they took their foot off the gas pedal, and price dropped. It takes financial commitment for the price to rise. All it takes for price to drop is buyers stop buying. And I went into detail in that discussion group post the other night and on the show yesterday. Buyers buy for a reason. And once everybody's reason for buying has been satisfied, buyers stop buying. Not because they're mad, not because they're no longer bullish. They're in, right? When you sit down to trade and you go long, what do? You sit there and you wait until one of two things happen. You hit your target and you take your profit, or you get stopped out and you take your loss. So at some point everybody's in, whether it's an up move or a down move. As price starts to decline, those who take profit here, if they bought to go long, in order to get out of that trade, they've got to sell. Even if you're using a bracket order, okay? Your entry on your bracket is to buy the market at whatever price. But once price hits your target, then the DOM, the bracket, is going to sell that contract. You bought a contract. Now to realize your profits, you've got to sell the contract. So once everybody's in and no one's buying for the moment, okay, and price starts to decline and people start taking profit, that creates additional downside pressure on the market. So whether you're selling to get out of a position, or maybe you just specialize in selling short. There's hedge funds that specialize in being short. They look for opportunities. You see, Mike Reed used to use this term. I know I talked about it yesterday. There are buyers up here, long, and they're what Mike used to call trapped buyers. They've either already been stopped out, or if they have a huge stop, it hasn't been hit yet. And of course, some people trade without a stop. You know our feelings on that. That's not trading, it's gambling. So different people have different pain thresholds, right? So when they just can't bear to take it anymore, they'll just go ahead and manually take themselves out of the market. Now, price, when it goes into a consolidation like this and like this, the market's reached a bit of an equilibrium. Okay, so these people up here, if they're still long, again depending upon their risk profile. Oh, I see Garrett popped in. I'm sorry, Garrett, let me open up your mic. Give me 1 second. There you are. Looks like you're muted on your end, Garrett. So you'll have to take yourself off of mute. Garrett, you're on mute. Perhaps you can't hear me. Unmute yourself. Okay, I guess I will have to send him a text message. Take yourself off of mute. Okay. Guess I have to call him. Okay.
Dwayne,
Yeah, you've got to unmute yourself.
I'm sorry. I had to help my daughter there, so I got pulled away. Let me, I'll jump off and unmute myself.
Okay.
Okay.
All right, so we've got price potentially finding support here at the step line. If so, that gives us window of opportunity to the upside. Want to see how this candle develops. Got potential resistance here, and that is the all-time historic high, so that's major resistance. So basically 43.47 to 43.49. 43.47 to 43.49. All right, Garrett, your mic's open.
Hi, Dwayne. How you doing?
Good, buddy. Welcome to the show.
Yeah, thank you.
Good to have you with us.
Not too much different from the last time we were talking. A couple of things. Some of the things that we look at involve, in my own technical indicators and so forth, but also some trading bands that use the price history of whatever that vehicle is, whether it's an index or if it's an individual stock.
Keltner, Bollinger's, that type of thing.
Well, yeah, kind of, but it's a proprietary thing,
Gotcha.
but based on as long a history as you can get on whatever that vehicle is. So on the Dow Jones, for example, you can go back 110 years, or certainly over a century, which is pretty nice. Some of these other ones.
Keep in mind, guys, that Garrett's always talking about the cash market. You can't trade the cash market. He uses that as a point of reference. Everything that we talk about is always the actual futures market. So just want to make sure everybody understands.
Yeah, and of course the futures markets are based on the cash market. So,
Exactly, right. You cannot trade the index. The cash market is an index, the S&P, of course, 500 companies. If you took a snapshot,
well, there are vehicles that allow you to trade. You can buy the SPY, and there are various other equity indexes that you can buy. And of course, you can buy options on things that are directly.
Yeah, and futures. So the S&P 500 is an index of 500 large cap companies. If you took a snapshot of the price of every one of those companies right now, and you divided that by 500, that would give you the current price of the S&P 500 cash index. Now, because you can't actually trade an index, man created derivatives, which is what Garrett was just explaining. There are
Right.
derivatives that allow you to trade based upon the information you get from the cash index, futures, options, number of different things that you can trade. You just can't trade the index itself. It's used as a point of reference. So, with that said, go ahead.
Yeah. So anyway, so what I was saying is that these bands, whether they're on an index or on individual stocks, when they're reached, you're at an extreme. So again, this is a game of probabilities. There's no exacts. So the higher the probability, the better your opportunity of making a profit on a trade. Anyway, what's happened is, in what I'm referring to now is I have a long-term friend and partner who is using these bands.
Mm-hmm.
One of my other partners, people might know, is Peter Eliades.
Mm-hmm.
And Peter has price projections that he derives using something. And I look at these things. I try to, and the third person is the person that uses a numerical system that he picked up about 40 years ago from the actual inventor, and has now taken it over himself and got all the past history from the other person. So a couple of things here. 3 different methodologies, this isn't including my own, that look at things in 3 different ways, all having to do with the price of the market to some degree, and what stocks or individual indices are doing. But one is a price projection situation. The other one is price history based in bands, and the other one is numerics, which is using, obviously closing prices or intraday prices, and using them in a certain methodology. So they're all different. They're all different aspects, and each of these are things that the individual people have at least 3, if not 4 decades or more experience with. Both of those are really important to me. And then I have my own where I've got the same. Again, 40 years worth of experience with it. And the benefit of experience is, with respect to markets, you just get to see more time. And the more time you can see, the further back you can go, the further history you have in anything. It's not only the stock market. I mean, if you're a mechanic and you've been doing it for 40 years, you'd probably be a better person to ask than somebody who's been doing it for 2 years. That isn't always the case, but generally there's a lot to be said for that. Same thing with the market. You've got to go back to you got a flash crash. I would say that the crash that we had last year was pretty much of a flash crash. The other flash crash, however, you have to go back to 1987. So you're looking at 40 plus years there before you had one. So you can't really refer to one within that time period because there wasn't one. So you can talk about it, but it's not something people can see without going back and checking history. So anyway, my point is, if you have 3 or 4 different methodologies that people have used for 40 years and they've used them well, then what happens after 40 years is this. You find out what doesn't work. Finding out what works is kind of what you want to do, and that's kind of the big deal, and that's the goal. But it's more important to find out what doesn't work. Because as you can eliminate all those things that don't work, and new ones pop up every now and then. I mean, you've got a market now that's been the result of QE, quantitative easing, zero interest rate policy. It's like there's been no other time in history where interest rates have been purposely kept down. We used to have a free country. We don't have a free country in a lot of ways, and it's not free in interest rates either. It used to be free in interest rates. So the interesting thing about freedom, and I don't mean to stand on a soapbox about this, but somebody's got to say something. When you lose your freedom, it's costly. The thing about freedom in the stock market is that it allows things to work better. You've got a history of, who knows if the market ever was free, but it's certainly been a lot freer than it is now. And particularly with interest rates. The good thing about freedom in interest rates is all of a sudden, if they go from where they are now, 0% to 10, 15, 20% like they were in 1981, all of a sudden things happen when interest rates are 21% as opposed to when they're 0. People think, you know what? I don't think I'm going to buy it, right? I would have bought it with a 3% interest rate, but at 21%, I don't think I can afford it. So that causes certain things to happen when you have that kind of a dynamic. We're not allowing that kind of a dynamic now. And that's, again, a freedom being taken away, and it's manifested in the market. So anyway, getting back to the other situation, I talked to Peter this morning. Peter said just about all of his projections have been met. I said, what? I said, just about. I said, that means not all of them. He said, well, the NASDAQ could go a little higher, but that would be an extreme reading. I said, how much higher? He said, only about 0.5%. And again, that would be an extreme. So we're at pretty much a limit there. We've come up on some of the things, and let me be specific about that. On the S&P, it can go, now I'm talking about the gentleman who uses the bands, upper price band, lower price band, think Bollinger Bands, but that's not what this particular thing is. But in his situation, Apple is coming up as being, overdone and probably a sell signal now. And Amazon and Microsoft are very close, and I can't remember, maybe another one, but when you are talking about Apple and Amazon and Microsoft, while you're only talking about 3 companies, you're talking about a pretty decent percentage of capitalization and market value with just those 3 companies.
Yeah, this
this
whole rally relies so heavily on just a handful of companies. And the whole purpose of an index, the whole purpose of an S&P 500 or a Russell 2000 or the NQ100 is that you're diversified, your risk is diversified across a multitude of companies. However, as you just said, we're in a precarious situation where the health of the economy relies on just a handful of individual companies.
Yeah, and we've got, to finish off, I guess, so again, we're overbought in the bands. I mean, they're at extreme readings. All of Peter's projections for the NASDAQ and pretty close in the S&P as well, and all these stocks are either in the NASDAQ, and or the S&P. So that's there. My numbers guy came to me the day before this and said, boy, we're there in Apple's getting ready to set up a big sell signal. And he looks at the various indices, and I think only 4 stocks. So he may or may not be looking at Amazon and Microsoft. I know he looks at Boeing and a few other, but he just looks at a very small number of stocks. But Apple came up on his system. And as I look at it on mine, I haven't got a sell signal yet, but I could get one today. I mean, it's, if it turns here, it could happen today. And I noticed when I look at what I was doing was just nothing really to show of any importance to share the screen or anything.
I'd be happy to see the screens if you got something you want to show.
Well, we can share it, and I can go through kind of the process that I'm looking at, and that might be interesting, for somebody. I can kind of just go through what I look at on the QQQs. The QQQs are a proxy for the NASDAQ 100. But I'll show you, I can at least show a couple of things that I'm looking at here.
Okay, guys, if price continues, I'll send you the screens. If price continues to drop, guys, if we take out the low of this candle here, which is 14,770 and change, your window of opportunity is 14,766 to 14,756. That's $200 per contract traded. If there is momentum to the move, okay, keep an eye out, look left. There's potential support here at 44, and then again at 40. And then you've got the weekly trading zone, which is 14,727/28. That's already served as good support once today. So this resistance sent us to support, which sent us to resistance. The market is now looking for support. If we get a close back above the BBC, then we know that the market has found the support it was looking for, which will send it looking for resistance, and then that will give us a window of opportunity to trade on the long side up here. However, we've got to wait for market structure to develop so that we can determine, where our entry point is. Of course, the final trade to target on a long trade is always the weekly zone overhead. So let me send you these charts real quick. Here we go. Here we go. And there we go. Okay. The charts are yours.
Let me know when you can see them,
I
and
can
I'll.
see them. Got it.
Normally, I'm just kind of going through the procedure that I do when I'm looking at a chart, just to try and get an idea of what prices. And I started out using trend lines because the first book that I bought, or I think it was gifted to me actually, was done by a guy named, it's called The Profit Magic. Actually, I'm sorry, that's another one that I bought. The Profit Magic of Stock Transaction Timing is done by a gentleman named Hurst, which is a completely different thing. But I was,
he was the aviation guy who did the Fisher Transform, if I'm not mistaken.
Yeah, he was an engineer type of
he worked
mind.
in the aerospace. He was in the aerospace industry.
Yeah, J.D. Hurst, and he really, for somebody who really wants to get into cycles and really be a student of stuff, and it really requires a real love for mathematics.
I studied him, and I studied his work, and while it was really quite impressive, I found no way, for me personally, and that's just me, I found no way personally for that to in any way change the outcome of the results that I got from the business of trading.
Yeah, I think they're two different things.
I'm just a pretty simple kind of guy.
Yeah, and by the way, J.D. Hurst's thing is anything but simple. Yeah. Right? Yeah, I mean, it's. I think if you were just a master mathematician, and somehow those things just. I know I have a friend like that, and where these things just easily fall into your head, then that's a different story, I guess. But that's rare.
But even after all the work and all the computations, at the end of the day, the outcome of his trading, or anyone's trading, is not going to be 100%.
Right,
an average trader on a good day may their analysis may match the outcome, 70-80% of the time. In many cases, 50-60% of the time. So,
I find that trading and technical analysis and trading are two different things. Trading's how you apply it, and technical analysis is what you do to make a decision.
If there's more buying pressure than selling pressure in the market, then you should either be long or look for opportunities to be long until that situation changes and there's now more selling pressure than buying pressure. Then you either step aside or get short. That all sounds very elementary, and I know it is disturbing for folks who spent many years and spent tens, in some cases hundreds of thousands of dollars on all kinds of methodologies and strategies and holy grails and whatnot, I mean, bottom line is you look at a chart, and if you've learned how to read a chart, if you understand how price flows, and if price is moving up, whether you're looking at a 1-minute chart or a 1-month chart, then the next step is just look for an opportunity to get long. And if price is falling, you look for an opportunity to get short. And the outcome of that complicated trading, like a Hirsch, or just the simple elementary, the results are about the same. So, yeah, it's I know it's a lot of people really enjoy the math. They enjoy the hunt, the chase. So each trader has to determine for themselves, what kind of a trader, do I want to be? Do I want to spend? Do I want to try to know the unknowable, or do I want to simply accept the fact of what's in front of me and work with that? And there's no right or wrong answer there. Every one of our traders that comes on board, after they're with us for a bit, they determine what kind of a trader do they want to be. Are they looking to, put on long-term trades that last days, weeks, months, or do they want to come in every day and just earn their daily bread? And then they write a business plan and a trading plan to accommodate who it is they want to be as a trader. And in most cases, a trader starts out wanting to be a short-term trader, and when that doesn't work, they decide, I've given a lot of thought, I'm going to be the long-term trader. And then when that doesn't work out, then and I say, hey, stop. You keep flip-flopping from one side to the other. Go back to your business plan, go back to your trading plan, determine who you want to be, and then become that trader. You can't change your swing every time you step up to bat. Every moment in the market is a unique moment. You have to become the constant integer in the equation. So anyway. Very true.
I was going to say, Dwayne, I'm expecting a call fairly soon. Actually, the gentleman we were talking about. But let me, if I may, I'll just quickly go through this. Sure. And then I've got to probably get off because the call is going to come in. So I'm sorry to interrupt you. The book I was talking about, and it's not important to get because since then, this is 50 years ago, there's probably 100 books that are better, but it's it's How Charts Can Help You in the Stock Market by William Giler. And I started out with trend lines, and it's the one thing I've never given up, and I've learned how to draw them and what they mean. And they're not just going from bottom to bottom necessarily. What I started out on this is the QQQs, which is the basically the proxy for the NASDAQ 100. And I'll draw a trend line like this from low to low, and then draw a parallel here, and I get an idea of this is the definitive price action during this time up until mid-Feb to the February top, which was the top for a little while. Now we've gone up and we've exceeded that. This line can go up here, but it's not necessary because price hasn't gotten there. And frankly, if you want to drop it down a little bit, maybe this is the line, and that's an aberration. Apparently, that's the case. The reason that this trend line is drawn in here is, and I would make these a different color if I was going to talk about this on your show, but this is just kind of in the midst of things. I noticed from here to here, and paralleling that off. By the way, we're getting close to that, what might be the barrier on that. This is the new price angle, which is a little bit less than the prior angle. This line that I was going to draw here was actually off this top and this top, and it was more for curiosity than anything else. Does this help us out? Let's extend it to the right and see. Well, if we take it from there and bring it down maybe to this earlier one, we're starting to say that here or not too much above there, things would somewhere in here, if the market gets up there, you're going to get pretty oversold, and really it should be resistance. And because you're getting, see this horizontal line? I don't know if you can, does that show up?
Sure. Yeah, I can see it.
I've just taken the tops, what this should, let me just make this a little heavier so we can see it. This is my own indicator. It's based on the MACD, moving average convergence divergence. I think Wilder did it, but basically what I like about this indicator is as long as the market keeps going up, this is going to keep going up. With the stochastic, the market can go up and plane out, and then the market can keep going higher. So that doesn't do you any good. This will go along with the market. So while this may look pretty extreme to me at this particular point, let's say, again, we're higher than we were before that. At the time, this indicator wasn't that high, and then it ran quite a bit higher. So it's telling me until this line, this light blue line, rolls over and reverses, and until these bars get shorter, it's saying, you're not getting the sell signal yet. So as crazy as it may seem, and it probably did seem pretty crazy then, it's saying stay in, or at least if you're not in, you probably don't want to short it just yet. And if you look at where this line is, that's right there at the peak, and boom, here your other line's rounded over. So every once in a while I get a signal like that at the top. This one is a day later, but you do get a correction. I put this horizontal line in because this is kind of, we come up to this point, and not every time when we come up here is it a top. It's a top here short term for a few days, and it's a top here for a couple days, and here you come up, and once again now you're way over it, and it's a top, and you actually get a correction that lasts for maybe a couple of weeks. Here you come up to it, boy, you turn around right away. But here you're in the midst of a run up, and these aren't necessarily tops. I mean, they're short-term tops. Here's one here. Now this is almost a divergence. The market goes higher, my indicator doesn't go higher. So when this turns down, now you're thinking about maybe we got a trade, and lo and behold, you did. Over here, now I wanted to point this out because you like to see divergences, and there aren't too many in this chart. This is just eyeballing it. This is the closest to it, and actually this isn't a divergence either, because I think this is a bit higher than that. But between these 2 points, price did go higher, and the buying pressure, although it went higher, it didn't go much higher. So this is where you kind of look for a sell. When you come over here, here's an example of a divergence. I believe this is higher than this. Let's find out. 342. 342. They're pretty similar, but look at the divergence here. Now you've got a divergence, and when this bar, these are getting higher here. When this turns down, I got to sell right there. Okay, where's that? Right there. That's a good place to sell, and you've got a correction. Well, now we are in kind of a similar situation, maybe as this, really, because here at the last peak, which is right here, we are now higher, obviously. But the buying pressure is higher too. So you're not going to get a divergence. Now I'm still looking at this as a potential sell, because if this doesn't climb, we've got at least a similar amount of buying pressure, and if it falls off, we're at a higher price. So we ought to get a correction here. And then, because this is the index that has a lot of those technical stocks, Apple, Microsoft, Amazon,
Right.
and because we're getting sell signals on those. Now, again, some of those aren't sell signals yet, but they're right there. I mean, they're right at the thing, and any type of a price movement is going to give you a sell signal. And because those are such large capitalized stocks and make up, I don't know what the percentage of this index is, but they probably make up a certainly a decent percentage. At least, it's an index of 100 stocks. This is 3 stocks. There's 3%. I'll guarantee you they make up a lot more than 3%.
Yes, I agree.
Yeah, if they're going to top, and it looks like they are, and we're running into resistance here, and then we've got this upper line resistance a little bit higher, and if we drop it down to this lower level here, you get right into the picture. And frankly, if you redraw it from here, see, sometimes these are orthodox tops, and then these are overruns. That's what happened in 1987. 2007. You had a top on July 19th, and then you had a little bit higher high in October. But if you bring this line down, tell you what, why don't you just redraw it, and then you don't have to worry about trying to make it. Like I say, if I was preparing this for you before, I would have had these in with different colors. But if you just happen to go to this one again, and this is why I'll use these type of trend lines, because it gives you a little input. If this is a meaningful high, this isn't that much of a higher high. If you run it through this top instead of this one, now you're coming in again where this line is coming in. You've got a couple of lines. You know it can go higher because of this, but this is a viable line as well. Another thing that you can do with the trend line, and just for fun, prior to this low, this was the low trend line, right? So what happens if you pop it up to there? Can that be helpful to you? Well, it doesn't look like it, unless, of course, you extend that line. And if you extend it, something happens. Right? I'm sorry for, since we're focusing on one line at the moment, let's get rid of these other ones. Like I say, I would have done these with different colors, but I'm just playing around, and I wanted to show something to your audience about certain things that are viable. Is this a viable trend line? Well, sure it is, but let's pop the parallel in and see if it's viable. Well, look at that. It's pretty darn viable. It's hitting here, all along here. So yeah, this price angle is a very viable angle. Now, how does this help you in the future? Maybe it doesn't, but now you've broken this lower line. You've rallied up to test it, fallen away from it, and now you've rallied up, hugged it for a while, fallen away from it again, gave another effort, couldn't get to it. And where does this happen? As I'm watching this, I've broken a trend line. It's showing me weakness, although the markets come back because it's the NASDAQ with all the sexy tech stocks. But you touch it here, you've got a peak in my buying pressure right there, and you come up and touch the line when it peaks. Now it diverges. You come up and make a higher high, but you can't reach the line. Now I've got a divergent sell signal, and I've broken this line. This is a pretty easy sell signal. And what happens? It goes from 342 down to 316. So pretty nice little trade there, and everything's in your favor. I mean, you got a 90% trade there. Maybe extend this line out and see if it does anything. It's probably done its job. Yeah, no. I mean, if we get up there, maybe it's a different story. But we already know that we've got some pressure here. We know that we're getting into this overbought territory. We know we can go above it. That can happen. But when you're getting sell signals popping up or near sell signals on the real big stocks like Amazon and Apple and Microsoft, then the odds are, and again, this is just an odds game, the odds are that this might be a pretty good time to take a position. And if you're wrong, you're probably not going to be wrong for long or for a whole lot. And of course, if you're smart and you use a stop like you're taught to use by Dwayne, then you don't have to worry about that anyhow. You're just out. When you're out, then you're free. If freedom is there again, you can wait and place another trade. And I will tell you that
getting stuck in a trade is not only expensive, but it's doubly expensive because it doesn't allow you to participate in any fresh opportunities that present themselves.
Completely takes away your freedom. Then all of a sudden you're locked into a trade, and then you have to trade your way out of it. And if there was anything for me in many decades, it's the hardest thing. It's the simplest thing to apply, but the hardest thing to learn. It's that. It's like, I don't care what your trade is, put a stop on it. And have I learned that?
Back in 2005, bracket orders were not common. In fact, not all brokers even offered them. If you wanted to place an order, you had to, in effect, place 3 orders. You had to place the price that you wanted to get long or short at, and then you had to place another order for your target, and then you had to place another order for your stop loss. And today, modern technology, which started around 2006, I believe it was, with one mouse click, you can establish your entry, your target, and your stop loss with one click. And that, number one, it simplifies the process, and number two, it takes emotions out of the equation, because you've predetermined, how much you're willing to risk. And so when price gets to that area, you're not going through this mental battle, oh man, maybe it'll turn soon, let me just hang in a little bit longer. Let me just hang in a little bit longer. It's amazing how long we'll stay in a losing trade and how quick we are to jump out of a profitable trade.
It's Dwayne, it's the I think it's the hardest thing to learn in all of trading, and it's the simplest thing, because it's if you get somebody who is new and has never traded before, and you just tell them the first thing, you put a stop in whenever you trade. It's the kindest thing you can do to a person, because I know people who have been in this business over 50 years. And the one thing they say that they always wish they've done, and I'm foremost in that group, every trade that I wished I hadn't made in my life, having that stop in there would have eliminated that problem. Every one of them. And when you've got something that can
and if you get stopped out, and the original premise for the trade reasserts itself, you can always get back in.
Exactly. And even if you don't, the difference is this: you have an opportunity cost in that case, and opportunity costs are always better than real costs. Real costs are the ones that come right out of your pocket, and it's a memory, and you go, dang it, I'm never going to do that again. And then you do it the next time. And professionals and really good traders still do that. Doesn't mean they're not a good trader. It just means that had they used a simple stop, they'd be a better trader. That's all. But it's the one magical thing that can remove 100%, in most cases, 100% of the bad things that happen. There's no question you can get stopped out of a trade and then be right as rain and miss it. That can happen too.
Sure.
But it's still always better than the alternative, which is being in the trade at the wrong time, having it go against you, and then having to waste effort by having to trade your way out of it, where if you just got out of it, there's nothing to trade your way out of. You're just on to the next one. So anyway,
that's
I got lucky and that call didn't come through yet, but Dwayne, let's talk this afternoon, because I got some more information for you on the other issue we were talking about.
Okay.
So
feel free to call me anytime.
Thank you for letting me share some time with your audience. I always enjoy it. And
I always enjoy it as well, Garrett.
Everybody have a great day.
I'll talk to you this afternoon. Take care. Okay, here's where we left off on the NQ. Obviously on the pullback here to the BBC, the market found support. That's what we expect to happen, so proven otherwise. And so that support took us to the weekly trading zone, which we expect to be good resistance when price moves up to it. We consolidated. That's the most likely thing to happen at a weekly trading zone. The zone is 65/66. 865/866. Yes. And the high of the session, 83.75, because nobody wanted to pay 84 at that moment in time. However, this candle right here, let's go insert indicators, volume. So this candle that put in the high, okay, the high volume candle, biggest candle of the day. That was the 9:30 a.m. Eastern opening candle. It was a bearish engulfing candle on the 30-minute chart. The high was higher than the previous candle high, the low lower than the previous candle low. That set the tone. So we came down to the BBC, bounced for just a minute, and then we traded right down to the weekly trading zone at 727/28. So we went from the zone down to the zone. We've now pulled up to the BBC, which we expect to be resistance until proven otherwise. On the initial pull up, it was resistance. From here, it gave us a leg to the downside to 14,770. And so if buyers, we've got this high, this high, this high, they all three line up. Okay, so we know there's resistance there. We had 3 attempts to break through that level. Buyers have not been committed enough to make that happen. If they do make that happen, that brings us to a window of opportunity from roughly 840, conservatively up to 860. 840 to 860. It's 20 points, $20 a point, $400 per contract traded. If buyers are not able to overcome this resistance, okay, and in essence stop buying, then price will reverse and it will encounter this support level right here, highlighted by that low and that slightly higher low. And so that generates a window of opportunity from 14,766 down to 14,756. That's 10 points, $20 a point, $200 per contract traded. From support to resistance to support to resistance to support. Currently at resistance. If the next candle, which comes out in 15 minutes, if it starts to print red, then we'll know that the market is back in the looking for support mode. Okay. Now, if it becomes a strong momentum move down through this window of opportunity, then we might just glide right through that support, which will bring us back to the zone at 727/728. As futures traders, we don't care if the market chooses this window or this window. What we don't want is we don't want to trade in this sideways market. That was the opening candle on Wall Street, where the market reversed, gave us a bearish engulfing candle. Okay. Now I point out the bearish engulfings whenever they happen on the daily chart, but if you look on your intraday charts, you'll see them as well. Okay. And again, the definition is this bearish candle had a higher high and a lower low than the previous, not only the previous candle, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles. This engulfed the previous 11 candles, the 30-minute candles. So it's at 5.5 hours. Okay. Took us right down to the zone. So this is rejection. Remember, 3 things happen at a weekly trading zone. The most likely, consolidation, 70-75% of the time. Second most likely, 20-25% of the time, rejection. The third and least likely, but it does happen, the slice. Okay? So this candle was green all the way to the top. We now got 13 minutes left in the life of the candle. Potential support at red and falling, and then that low, and then that low. If we trade below that low, then the next visible area for potential support based on historical price action and current price action would be the low of this candle. You see, this candle was red all the way down, and buyers came in and drove it up. This candle was red all the way down, but before the 30 minutes were up, buyers came in and drove it up. This candle opened and was red down to the low, and then as buyers came in and drove it up, that red candle became wick, and the body of the red candle got smaller as the wick got bigger, until price got back to where the candle opened, and it became a green candle. When price approaches the BBC from below, we expect it to be good resistance, and it was. When price approaches the red and falling from below, we expect that to be good resistance till proven otherwise, and it was. And so this is just middle of the day, buyers and sellers battling it out. Eventually, one of them will prove themselves to be more committed than the others. We've got a window of opportunity overhead, window of opportunity below. Your job is simply to be patient and trade whichever presents first. Okay. All right. So we've covered the S&P. That window of opportunity that we drew earlier on the S&P, 43.47 to 43.49, as you can see, price did the next high probability thing. We did not know that this would happen. We simply knew that was the next high probability thing. Why? Well, price was above the BBC. When price is above the BBC, we anticipate higher prices. When price pulls back to blue and climbing and finds good support, we anticipate higher prices. Where do we expect there to be good resistance? Weekly trading zone, 43.52/53. And as you can see, there's the resistance right there. Now, 20% of the time, price does not do the next high probability thing. Plain and simple. Over the last 153 weeks, 7,700 however many alerts. On average, 20% of the time, what you just saw happen here doesn't happen. 20% of the time, the next high probability thing doesn't happen. because order flow switches. Okay? Often for no apparent reason. It just does. And you cannot foreknow that. There's no indicator, no oscillator, no crystal ball. Nothing. Nothing in this universe that can tell you with certainty order flow is going to switch here. Okay? But you can know with certainty what the next high probability move is. And you can know with a great degree of high probability where the market's going to find resistance, as it did. Now, what's the potential for price to come back to 43.47 and do it again? Very high. Once an alert triggers, there's a greater probability of it triggering multiple times than not triggering multiple times. Okay, so that was the S&P. We already covered the Dow. The Dow, we went from support to resistance, back to support, back to resistance. Now the market's looking for support. That's how it works. Support to resistance to support to resistance. Zone to zone to zone to zone. If we overcome this zone, if we take out the current high, this high, this high, and we have a window of opportunity up here, and there's an alert in the channel, 34,595 up to 34,615. It's 20 points, $5 a point, $100 per contract traded. A leg, a retracement, a leg. Question is, are buyers committed enough to take out the previous swing highs to get us to the window of opportunity? If buyers were to stop buying right here, and we have a nice big window of opportunity on the downside from roughly 440 down to 400, 40 points, $5 a point, $200 per contract traded. So again, as futures traders, we're okay with however it plays out. No algos required. By the time you and I talk tomorrow at this time, price will have either filled this window of opportunity or at least tried, or it will have filled this window of opportunity or at least tried. Remember, 20% of the time, based on over 7,000 alerts and 153 weeks, we know with certainty 20% of the time the market does not do the next high probability thing. Okay, the Russell. Here's the open last night for the Russell. Consolidated sideways at a weekly trading zone. What's the most likely thing to happen at a weekly trading zone? Consolidation. Never triggered on the long CTA, but the short CTA did trigger. The CTA was 22.55, and we traded down to a low of 22.29. We'll call it 30 to be conservative. So that's a 25-point move in one 30-minute candle at $50 a point. A 20-point drop would be $1,000 per contract traded. It's a 25-point move. 22.30, 22.55, 25 points, $50 a point. Now, buyers came in, took us back up to the BBC, which we expect to be good resistance. And it was. When the market finds resistance, what's its next job, or what's it going to do next? It's going to go look for support. Will it find it right here at red and falling? It may. If it doesn't, and there's window of opportunity from 22.43 down to 22.40. So 3-point window of opportunity if we get through there. We have another window of opportunity here. And 2210/11 is the lowest weekly trading zone for this week. Moving lower is the path of least resistance. In order to trade higher, price would have to overcome the high of this candle, the BBC, and this swing high. In order for price to move lower, we simply need to trade below the low of the current candle, which gives us a window of opportunity to the low of this candle. If we trade through that, then we have from here down to here. And if we take out that low, we've got all this final window of opportunity, 24 to 22.10, that's 14 points, $50 a point. If price were to overcome these obstacles I mentioned, then $22.66 up to $22.68 up to $22.70/71. So it doesn't matter which way the market chooses to trade. The windows of opportunity are clearly defined. Just got to trade it. All right, there's the NQ. We already talked about that. Window below, window above. Nothing to do right now. Crude oil. Crude oil traded down through the short side CTA at 72.80. Traded down to the zone at 72.10/15. So that's a $650 per contract move, but it kept going. But if you just took profit at the target, which was 72.15, $650 per contract traded. But it traded all the way down to 71.15. A $1 move in the price of crude is worth $1,000. $1 move in the price of gold is worth $100. $1 move in the price of silver is worth $5,000. So what's the high probability move from here? Well, price already walked sideways. The step line already crossed over to the right side of red and falling. And so the counter trend window of opportunity is right here. 72.45 up to 72.75. $300 per contract window of opportunity. You won't see that one in the alert channel though, because it's counter trend. All 7,000 plus alerts in the channel over the last 153 weeks are all trend trades as defined by a 30-minute chart, price, and the BBC. Okay. Here's gold. Here's the open last night. Price came down to the zone and went to the zone. Then it tried to come back to the zone, and then it went back to the zone. The CTA was at 1807. We put in a high at 1809. That's $270. And it did it again. 320 bucks. And then it did it again. 160 bucks per contract traded. That's what the market made available. No trigger on the short side. Market opens at the zone. We consolidate, most likely. That's what happens most of the time. We get a leg. We get a retracement to the BBC. The pullback holds more often than it doesn't. So then you just get long up to the target. It overshot the target and actually triggered the CTA. Price then pulled back to the BBC where it consolidated, and it's still consolidating. So I'd like to see a break of this high roughly 1811 up to 1813. It's $200 per contract traded. Or 1799 down to 1798. Yeah. Or 99 to 97. Now they're cutting it a little close there at the 97. And then you got the zone where you would anticipate support until proven otherwise. And last, silver. Here's the open last night. Consolidated at the zone. Price ran from zone to zone. From 26 and a quarter to 26.46. Just barely hit the CTA. From 26.52 we went up to 54. 2 pennies. $100. And again and again. And then on the short side, the swing low was 26.06. 2 pennies. $100. And so what's the next high probability move from here? Well, price came down, leg. We got a retracement up to the BBC, which we expect to be good resistance, and it was. And so now 26.21 down to 26.19, and then below that 26.16 to 26.13, and then there's all this room down here if we take out that swing low at 26.06. And that brings us all the way back around to the daily chart. Bearish engulfing yesterday, green candle today. Resistance overhead is today's high, and above that 43.62. And that brings us to our good word for the day. Answering the big questions. Life's full of those big questions. 2 Peter 3:13 says, we are looking forward to a new heaven and a new earth. But according to his promise, we are waiting for new heavens and a new earth in which righteousness dwells. So here's one of the big questions in life. What about suffering? Doesn't that prove there is no loving God? Adam was given a choice to obey God or disobey God. Adam chose disobedience. And God said in Genesis 3:17, cursed is the ground because of you. Through painful toil you will eat food from it all the days of your life. Note the word painful. Think of how many people are living with cancer and Alzheimer's and multiple sclerosis, heart disease, emphysema, Parkinson's, and other debilitating illnesses. Did God blow it when he created humanity? Sadly, many use the issue of suffering as an excuse to reject any thought of God, when its existence is the very reason we should believe in him. In the beginning, God created perfect humans, and they lived in a perfect world without suffering. It was literally heaven on earth. When sin came into the world, death and misery came with it. So what's the ultimate answer? 2 Peter 3:13. We are looking forward to a new heaven and a new earth, where righteousness dwells. So then, dear friends, since you are looking forward to this, make every effort to be found at peace with him. Suffering reached its height when Jesus said from the cross, it is finished. Those words mean paid in full. They mean that when you accept Jesus as your Savior, you will go to heaven when you die, and you will live in a glorious earth made new without sin or suffering. 1 Corinthians 2:9, no eye has seen, no ear has heard, and no mind has imagined what God has prepared for those who love Him. So friend, if you're not sure whether you've accepted Jesus yet, I encourage you today, put your trust in Him. Good brother, that's all you got. And that's our good word for the day. Thanks so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading E-mini futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.